Ever wonder what it really takes to get, truly exceptional returns in the stock market? I mean, not just good or even great, but what some people call super performance.
Mhm.
Imagine turning maybe a modest amount of capital into a significant fortune. And relatively quickly, too. We're talking about a stock climbing, what, a minimum of 300% in just 2 years, that kind of thing. Today, we're doing a deep dive into some really fascinating sources. We've got excerpts from a Master Trader Program workshop and also the book Trade Like a Stock Market Wizard. Our mission really is to unpack the core ideas, the strategies behind finding these super performance stocks. You'll get a look at a systematic approach, one that tries to put the odds, squarely in your favor based on years of real experience and some pretty meticulous research.
Yeah, and what we're digging into here, it's really not about just getting lucky or, guessing. It's a very deliberate method. It's built on understanding how markets actually work, recognizing specific patterns, and maybe most importantly, really disciplined risk management. We'll show you how to spot the characteristics that often pop up before these huge price jumps happen. So you potentially have a chance to get in early.
Okay, let's unpack that. Because super performance, it sounds almost, well, mythical, right? Like something only a few lucky people ever achieve. But these sources, they really highlight a journey. Someone starting really small, like incredibly small, and ending up winning the U.S. investing championship. So this isn't just theory, it's based on like lived experience.
Exactly. I mean, the core insights, they come from someone who started with just a few $1,000s and turned that, through winnings, into a personal fortune, averaging something like an astounding 220% per year between 94 and 2000. We're talking a 33,500% compounded total return. Won the U.S. Investing Championship in 97. It's also inspired by others, like David Ryan. He won that championship 3 years in a row. The absolute core principle, though, the heart of their success and what we're talking about, is this risk-first approach.
Okay, and here's where it gets, I think, really interesting for a lot of us because these sources, they directly challenge some really common investment sayings like buy low and sell high. I mean, that's almost gospel for some people, right? So why do these sources argue that, conventional wisdom usually just leads to conventional results and that high PE stocks, the ones that look expensive because they trade at a high multiple of earnings, why shouldn't we always just avoid those?
Yeah, that's a huge point. Conventional wisdom produces conventional results. It sounds simple, but it's profound. Think about large institutional investors. In a way, they're kind of doomed to mediocrity by design.
Hmm.
They've got limitations, right? Like committee-approved stock lists. They have to diversify broadly. And they're constantly being compared to benchmarks. So that often pushes managers toward, let's say, safer but slower growth stocks. But individual investors, like you listening, you have a massive advantage. You can react fast. You're not held back by the size of your capital or needing committee approval for everything. And as for those high PE stocks, well, the argument is powerful. You don't find top-notch merchandise at the dollar store. The really exciting, fast-growing companies, they often look expensive, precisely because their huge growth potential hasn't been fully grasped or priced in by everyone yet. I mean, think about Yahoo. Back in the day, it traded at like 938 times earnings when almost nobody knew it. And then it went up an incredible 7,800% in just 29 months.
Wow. So, okay, what does this mean for the individual investor, you listening, in terms of mindset? It really seems to hammer home the psychological side, especially separating your ego from your trading. The sources even mention something called the loss adjustment exercise. What's the lesson there? How does capping losses actually improve performance?
Oh, it's a huge lesson. The market, it truly doesn't care about your ego. Not one bit. Like the sources say, it's more important to make money than it is to be right. If a stock drops below where you bought it, that's a clear signal. You made a mistake in your timing. Simple as that. The hard part is psychological, right? Cutting a loss feels like admitting you messed up, and that hurts the ego. But that loss adjustment exercise they talk about, it demonstrates pretty dramatically how much performance can change. It showed that just by capping losses consistently, say at 10% on every single trade, a portfolio that was losing money could have actually turned into one with like a 70% gain. It basically teaches you that protecting your capital, taking those small losses even if you're wrong half the time, or even 60%, it's absolutely essential if you want to achieve those big overall gains. You learn to protect your money, live to trade another day.
That psychological discipline.
Okay.
Yeah, that sounds absolutely foundational. So, building on that, the sources then give us this framework for action, a systematic approach called specific entry point analysis, or SEPA. This isn't just theory, is it? It sounds like it's about being really precise in the market. How does SEPA actually help find these super performers?
It's absolutely about precision. SEPA's goal, its objective, is to pinpoint the exact moment to get into a trade. the moment with the lowest possible risk and the highest potential reward. And it does this by combining two really critical things. First, rigorous fundamental analysis looking at the actual company's health, its earnings, sales, margins. And second, the technical behavior of the stock, what the price and volume are telling us on the chart. It's about putting all that relevant info together to find that sweet spot for entry, not just making a guess.
Okay, that sounds like a solid blueprint. And the sources, they outline 5 key elements that seem to consistently show up in these super performance stocks. Can you kind of walk us through those 5, maybe give a bit more flavor to each one?
Absolutely. These 5 are really the core of SEPA. 1, trends. This stock absolutely has to be in a clear uptrend, specifically what they call a stage 2 advance. That means the price is consistently staying above its longer-term moving average, like the 200-day, and that average itself is pointing upwards. Shows strong, sustained buying. 2, fundamentals. You need to see a material improvement. And not just improvement, but accelerating improvement in earnings, revenue, and profit margins. This isn't just small growth. It's often a dramatic shift that happens before or right during that big price move. It's the fuel. 3, a catalyst. There's always some driving force. And not just any news. It's usually something transformative, like a game-changing new product, maybe a service disrupting a whole industry, a big new market entry, maybe a key regulatory nod. It's the why now that makes institutions really take notice and reevaluate the company. 4, entry points. These super performance stocks, they tend to offer at least one, sometimes several low-risk entry chances. These are moments where the stock has paused, consolidated its gains, and is signaling it's ready for the next jump up.
Gives you a clear spot to manage your risk with a stop loss. And finally, 5, exit points. Just as critical as getting in is knowing when to get out. You need to protect your capital and lock in profits. The sources really stress having a selling plan before you even buy. And it's not just about hitting a price target. It's about seeing when the stock's behavior changes, when it breaks key support levels, or maybe has a climax top, huge volume, wide price spread. Missing that can turn a great trade sour fast.
That definitely paints a clearer picture. Okay, so SEPA gives us the method. And you mentioned within that this idea of a leadership profile. How does that profile work? Is it like a checklist for finding these top stocks?
Yeah, you can think of it like a detailed blueprint. It's built by studying decades of actual trading data, historical charts going way back even to the late 1800s. It identifies the common traits shared by past super performance stocks. It was partly inspired by Richard Love's study on super performance stocks, stocks gaining in at least 300% in 2 years. It's basically an ongoing detective work, looking at the characteristics of the biggest winners of the past, to figure out what makes a stock likely to massively outperform its peers going forward, learning from history to spot the next potential winner.
Got it. And this idea of probability convergence really jumped out at me. The source described it like 4 cars arriving at the same time at a 4-way intersection. What does that mean exactly? Having all these factors converge, why is that so powerful?
That analogy nails it, really. For a high probability trade, you want everything lining up. You want the company's fundamentals looking great, the stock's price action showing strength, the volume confirming institutional buying, and the overall market condition being supportive, or at least not hostile. It's not about just one thing being right. It's about the confluence, the coming together of all these positive factors.
Yeah.
When you get that stacking of probabilities, it dramatically boosts your chances of picking a winner. It reduces the reliance on just, pure luck. It puts the odds way more in your favor.
That makes a lot of sense. Okay, so with this SEPA approach and probability convergence in mind, the sources then categorize stocks, which helps us figure out where to actually focus our search for these leaders. What are those categories? And which ones are like the real sweet spot for super performance?
Right, there are 6 categories discussed, but the main focus for finding these big movers is really on 4 of them. First and most important is the market leader. These are the ones you really want to concentrate on. They're often the first stocks to break out in the new bull market phase. They frequently look expensive, high PE ratios, high relative strength, or RS rankings, meaning they're already outperforming most other stocks. Strong earnings per share, EPS rankings too, and crucially, they're often small or mid-cap companies you might not have even heard of yet. Think Amgen back in the day up 360% in 26 months, or Lumber Liquidators up 240%, while the market only did 33%. DocuSign recently showed 120% gains when the NASDAQ was up only 36%. The advice is pretty strong. Put like 80% or more of your buying power into these market leaders, or maybe their top competitors.
80%. That's a heavy focus. So if market leaders are number 1, what about those top competitors you mentioned?
Yeah, the second category is the top competitor. These are companies that often shake up an industry. They come in with a new business model or a clearly superior product or service and directly challenge the big established players. Think about Netflix arriving on the scene. Blockbuster's stock peaked almost the exact day Netflix IPO'd. Netflix eventually soared over 3,400%, while Blockbuster, well, lost 99% of its value. Another great example is Michael Kors versus Coach. Kors shot up 329%, while Coach actually dropped 56%. And Amazon, of course, is maybe the ultimate disruptor in history, just revolutionizing multiple industries over many years.
Okay, leaders and top competitors. What's next?
The third category is the institutional favorite. These are the big, mature, well-known names, often called blue chips. Now, they might have solid track records, sure, but their growth is usually much slower. And they're so widely owned and followed by big institutions that there's often not much room left for that explosive price appreciation we're looking for. The sources even call this potentially the kiss of death for a super performance trader. Look at Cisco. Huge run after its IPO, gained 70,000%. But then after it became this huge institutional favorite, it basically traded sideways for 16 or 17 years. Qualcomm took 21 years just to get back to even after its massive early run. So the lesson is, when everyone loves it and owns it, the really big move might already be in the rearview mirror.
Interesting point. Okay, and the fourth category.
That's the turnaround situation. These are companies that were really struggling, maybe even close to going out of business, but they've managed to successfully turn things around, revitalize their operations. Apple is the classic example here. It went from being really unloved, almost forgotten, to this incredible growth story.
Yeah.
Between 2003 and 2011, Apple's net profit margins exploded from like 1.2% up to nearly 24%. Revenue grew 39% a year. EPS soared 114% annually. And the stock price, it went up 10,000% from its low in 2003. That's a turnaround.
Wow. So those are the main four. What about the other types, like cyclical stocks or laggards? Are they just completely off the table here?
Pretty much, yeah. Cyclical stocks, think paper, steel, basic materials. They mostly just move with the overall economy. They tend to have this weird inverse PE cycle, high PE ratio at the bottom of the economic cycle, low PE at the top. They generally don't make those sustained multi-year super performance runs, mostly avoided. And laggards, stocks that are consistently underperforming the market, definitely avoided. Sometimes people even look to short them because they clearly lack momentum and buyer interest.
Got it. So circling back to fundamentals for a sec, we talked about needing strong fundamentals. What are the absolute must-haves, the signals that a company might be truly ripe for super performance?
Right. In the stock market, as the saying goes, it's earnings, earnings, earnings. But it's more nuanced than that. You got to ask three key questions. How much are they earning? How long can they keep it up? And how certain is it? This gets at profitability, sustainability, and visibility. You want to see big earnings surprises beating expectations. You want accelerating earnings per share, EPS, not just growing, but the growth rate itself increasing. Same for revenue accelerating sales growth. There's this thing called the Code 33, which is like a really potent recipe. 3 straight quarters where earnings growth, sales growth, and profit margin expansion are all accelerating. That's not just a coincidence. It's a powerful sign that something fundamental is shifting for the better in the company. Often it means institutions are starting to notice something the wider market hasn't fully grasped yet. That consistent acceleration across the board shows the business model is really working, attracting smart money. Expanding margins, like we saw with Apple going from 1.2% to nearly 24%, that's also a critical sign of a healthy, improving business.
And also, watch for positive guidance from the company itself and analysts revising their earnings estimates upwards. Those often come before even better results and help fuel the stock price.
Okay, that makes sense. It's about the acceleration. Now, moving from the company's health to the market's pulse, the sources have a chapter titled, "A Picture is Worth $1 Million." Talking about stock charts, how do charts give you an edge? If it's not about predicting the future, what are they used for? Timing, risk management.
Exactly. Charts are incredibly valuable for understanding that constant battle between supply and demand. The fight between buyers and sellers. The approach here is called techno-fundamentalist, meaning you rigorously combine the fundamental analysis we just talked about with chart analysis. We're definitely not trying to predict the future with charts. Nobody can do that consistently. Instead, we're reading the market's footprints, looking for clues left behind by the big players, by supply and demand. Charts help us spot opportunities where the potential reward seems high relative to the risk we have to take. They let us see patterns created by human emotions, ego, fear, greed, and help us enter when the odds seem stacked in our favor.
Okay, so what are we actually looking for on these charts? The sources mention 4 stages of a stock's life cycle.
Right, the 4 stages. Stage 1 is neglect or basing. Stage 2 is the advancing phase. Stage 3 is topping or distribution. And stage 4 is the declining phase. Our primary focus, where the superperformance happens, is stage 2, the dancing phase. That's when the stock price is generally above its 200-day moving average. That average itself is sloping upward. And the stock is making this series of higher highs and higher lows, often moving up from one base or consolidation area to the next. That's where the big money tends to be made.
Okay, stage 2. And within that stage, there's this really key pattern mentioned, the Volatility Contraction Pattern, or VCP. What does that VCP pattern tell us? What's happening under the surface?
The VCP is absolutely crucial. It signals that the supply of stock available for sale is diminishing. It's drying up. And it suggests the stock is getting ready, coiling up for its next move higher. You can literally see the price swings, the volatility get tighter and tighter from the left side of the pattern to the right. For example, a stock might pull back 25% initially. Then it rallies, pulls back maybe only 15%, then rallies, pulls back maybe just 8%. This progressive tightening of price swings, usually happening on lower and lower volume. That indicates that the nervous sellers, the weak hands, have mostly been shaken out. There's just not much stock left for sale near that level. It's like a spring getting wound tighter before it releases. FSI International, for instance, jumped 130% in 7 months right after breaking out of a classic VCP.
Okay, so the VCP shows supply drying up. Where exactly do you pull the trigger? When do you buy?
That specific point is called the pivot point. It marks the completion of that consolidation, that VCP, and it's right on the cusp of the potential next big advance. The ideal pivot point shows the price getting extremely tight, moving sideways in a very narrow range on exceptionally low volume. That drying up of volume is key. It means there are hardly any sellers left. So even a small increase in buying pressure can push the price up rapidly. New Oriental Education, that's another example. It advanced 105% in 7 months right from a VCP setup, where the volume just shrank dramatically right at that pivot just before it broke out.
Right. And this brings us back to that kind of counterintuitive idea, buying high or buying strength. The sources really emphasize not being afraid to buy stocks making new 52-week highs. That sounds so risky to a lot of people.
It does sound risky, but it's fundamental here. Remember, you don't find top-notch merchandise at the dollar store. Stocks hitting new highs within a confirmed stage 2 uptrend, they have no overhead supply, meaning there aren't hordes of investors who bought higher and are just waiting desperately to sell as soon as they get back to even. These stocks are basically shouting, hey, something good is happening here and smart money is taking notice. They're demonstrating strength. Think about Yahoo. Again, it climbed 7,800% after breaking out to new highs when it was still pretty unknown. Monster Beverage rallied over 8,000% from its all-time high back in 2003. So being scared of too high can mean missing massive opportunities. The key isn't just buying any highs, it's buying a proper pivot point breakout from a sound base.
Okay, makes sense. There's also mention of an even more aggressive pattern, a power play, sometimes called a high-tight flag. What defines that specific pattern? It sounds explosive.
It is explosive. A power play is definitely a velocity pattern. It signals a really dramatic, positive shift in a company's fortunes. The setup requires, first, an incredibly sharp price move, like 100% or more in less than 8 weeks, just straight up. Then, it's followed by a very tight sideways consolidation. The correction should be no more than maybe 20–25% over a short period, like 3 to 6 weeks.
Oh, yeah.
And it needs to show those VCP traits, volatility shrinking, volume drying up within that tight range. This pattern signals immense buying demand and a real scarcity of sellers, even after a huge run-up. Quality Systems Inc. is given as an example, rising 127% in just 66 days from that kind of setup.
So putting the fundamentals and technicals together, it sounds like it's not enough for a company just to be fundamentally sound. It also has to be, what, price ready, according to these chart patterns?
Precisely. That's a great way to put it. A good company is not always a good stock, at least not right now. What really matters for stock price movement is what the big institutions perceive as valuable, and when they are acting on that perception. They're the ones with the buying power to move prices dramatically. So your job as an individual investor using this approach is to find companies that are both fundamentally strong and showing these specific technical patterns.
Yeah.
The patterns that indicate they are price ready for a big move. They show that supply and demand have reached a point where the path of least resistance is likely upwards.
Okay. Let's shift gears now to maybe the most critical piece of this whole puzzle, risk management. The sources are really clear on this. They say the market can and will break anyone who ignores the risks and dangers.
It's absolutely paramount, non-negotiable, really. The #1 rule, repeated over and over, is never add to a losing position. Never average down. As the saying goes, only losers average losers. You have to do the opposite. Scale up your position size when you're trading well and things are working. And scale down when you're trading poorly or the market is choppy. Losses work geometrically against you. Protecting your capital has to be objective number one, always. Think about it. A 10% loss needs an 11% gain just to get back to break even. But a 50% loss, that needs a 100% gain. It gets exponentially harder to recover.
That really puts it in perspective. But, okay, how do we actually know when we're wrong? And why is cutting losses, which sounds so simple on paper, why is it so incredibly hard for most people to do? The answer for knowing when you're wrong is, again, remarkably simple. How do you know when you're wrong? The stock goes down below your entry point. It's that direct. If a stock falls below where you bought it, especially below your predefined stop loss level, your timing was off, period. Nobody, absolutely nobody, can predict how far a stock might fall once it starts dropping. So trying to wait and see if it comes back, trying to break even, or becoming what they call an involuntary investor by just holding on to losers because your ego is bruised. That's a common and incredibly destructive trap. Remember the goal. It's to make money, not to prove you were right about a particular stock. And like we touched on earlier, even if you're only right 50% of the time, you can still make huge returns if your losses are consistently kept small while your winners are allowed to run.
Okay, so it's not just about gut feel. There's a more mathematical, disciplined way to set these stop losses based on your actual trading results, right?
Yes, exactly. The amount of loss you allow on any single trade should ideally be no more than half the amount of your average winning trade, based on your real results. So for instance, if you look at your past trades and find your average winner is, say, 15%, then your maximum stop loss on any new trade shouldn't be more than 7.5%. There's also this concept of an uncle point. Generally, if a stock drops 10% from where you bought it, that's often a sign something is seriously wrong with the trade or the stock, and you should strongly consider getting out regardless of your initial stop. And beyond just the stop on one stock, you need to know your risk of total equity, or ROTE. That's basically figuring out how much of your entire trading account you could lose on this one trade if your stop gets hit. It combines your position size with your stop loss percentage. Managing that overall portfolio risk is absolutely vital. You need to quantify your risk before you even place the trade.
That makes sense. And the sources, they emphasize contingency planning. They compare it to an airline pilot flying a 747. Why is that level of scrap so critical for traders?
It's a perfect analogy, isn't it? Think about a pilot. They have checklists and procedures for almost everything imaginable. Engine failure, bad weather, hydraulic problems. They can't afford to get emotional or freeze up when something goes wrong. They have to act decisively based on pre-planned procedures. Trading should be similar. You need a plan before things happen. What will you do if a stock gaps down overnight on bad news? When will you take profits if a stock has a huge, fast run-up? How will you react if the overall market suddenly turns sour? Having these plans in place allows you to act decisively without letting emotion, which is usually the enemy of good trading, take over. As the sources say, kind of amusingly, good trading is boring, bad trading is exciting. It's about cultivating discipline and good habits through preparation.
Boring, but profitable, hopefully.
Yeah.
Okay, one last area. Diversification. It's constantly pushed as the way for investors to reduce risk. How do these sources view diversification when the goal is actually superperformance?
Right, diversification is often touted as a free lunch, and it can smooth out short-term bumps in your portfolio's value, but fundamentally, it will not lead to super performance returns. Almost by definition, it leads toward average returns. Why? Well, in bear markets, most stocks go down anyway, so diversification offers pretty limited protection then. But in bull markets, which is where super performance happens, having your money spread across too many stocks means you dilute the impact of your big winners. It also makes it really hard to follow each company closely, to know when fundamentals are changing, or when to cut a position quickly if it starts to underperform. So the recommendation from these sources is actually the opposite. Concentrate your capital. Focus on a relatively small group of the very best stocks that meet all the SEPA criteria, maybe 4 to 12 positions for most individuals, not dozens or hundreds. This focused approach allows you to know your holdings intimately and manage them effectively, which is seen as essential for achieving those outsized gains.
Wow, okay. So wrapping this up, what have we really discovered today about chasing this idea of super performance in the stock market? It seems far from being just a game of chance or luck. It sounds like a pretty potent blend of rigorous analysis, understanding market psychology, especially your own, and just unwavering discipline, all aimed at finding those precise low-risk entry points in the right stocks at the right time.
Yeah, I think that sums it up well. We've seen that success here isn't really about predicting the market perfectly. Nobody does that. It's about identifying setups where the probabilities seem heavily stacked in your favor, and then crucially, managing your risk with almost surgical precision. The market, as we said, it doesn't care about your hopes, your opinions, your ego. It just responds to supply, demand, and powerful fundamentals. Maybe the most powerful lesson anyone can learn from this approach is to embrace mistakes, small losses as just a normal part of the process. But never, ever let yourself stay wrong by holding on to big losers.
That's a great final point. So, as you, our listener, reflect on this deep dive, here's maybe a provocative thought to leave you with. In today's really dynamic markets, what new industries or technologies do you see emerging that might be the fertile ground for the next super performance story? Which specific companies within those areas might be showing some of those early signs we talked about, becoming a category killer, a market leader? Are any of them potentially setting up near a pivot point right now? And maybe more importantly, what specific steps will you take now to really differentiate between a company that's just fundamentally sound and one that is truly price ready for a potentially significant advance?